there are two ways of analyzing returns. One is a point in time investment, and you evaluate the performance in the form of trailing returns. So the first part of this slide, the first part of the first half, it shows the trailing returns of QLTVF versus its benchmark BSE 500 and BSE 200, and what has been the difference in multiple periods of time. A positive number, it shows an outperformance, and the negative number, it shows an underperformance where it trailed the benchmark. The second part of the graph, which is the bottom table, that shows how an SIP investment into this fund would have performed over long periods of time. And on the right part of both the graphs, I have put the difference, the quantum long-term equity value fund minus BSE 200. The reason I have taken BSE 200 is typically QLTVF tends to be large cap biased because of multiple reasons. A prime reason for that is the liquidity filter, where we would require the stocks which are in the portfolio to trade at least by about $1 million turnover every day, which is about 8.5 crore. And that in itself skews the portfolio towards large cap. Even otherwise, there are governance filters and things which the large cap universe, as a proportion of the total universe, if we say, large cap tends to be more compliant in those requirements. So what you can see is the SIP performance in the bottom graph has considerably outperformed the index versus the trailing returns over long periods of time. And the reason why this is possible is, at any point in time, when you invest, the stocks in the portfolio has an absolute upside. And as and when that gets expensive, you are selling out of those stocks. Which means when you do a staggered investment across long periods of time, so irrespective of market levels, your investment has yielded a reasonably good return compared to the index. So this is an outcome of following a disciplined process. And as an investor, so this is something which you can consider when you believe that market levels are expensive, or you feel markets are trading above what should be the intrinsic value of market. The advantage of this process is, even if you were to see a market correction, most likely if you follow this process, you would be having a higher cash levels at expensive markets, because the fund manager would be selling out of expensive names. And if he's not able to find opportunities with those threshold upside potential, there is a very high chance that cash levels could be higher. And as and when the market corrects, he would be able to deploy at quite attractive levels. So this is a testimony of how a disciplined process can have a seamless experience over long periods of time. Thank you for patient listening. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.